In this video, we're going to look at the Dow Jones Index, what makes it up and why it remains such a popular market with investors and traders alike. I'm David Jones from Capital.com, and this is the latest in our series where we look at popular markets for traders. And I thought, well, let's take a look at the Dow Jones Index in a bit more detail and see why it is such a popular one for short-term traders, what makes it up, and the different ways of trading this in both directions with us here at Capital.com. So let's get into it. We'll have a quick look at the market, then I'll go through some of the facts about the Dow, then we'll go back on the trading platform. So if you're not familiar with the Dow, let's just take a quick look at this market over the last 8 months. So you can see back in October 2018, the Dow had pushed almost as high as 27,000. Then we saw this big sell-off into the end of 2018 that saw the market down around about 21,700. So we'd seen a move of about 5,000 points over a few months. And then into 2019, we've seen this market bounce back. So it's recovered something like 5,000 points again the other way. So you can see why with this sort of volatility over short and medium term, it's a market that does appeal to traders. So let's take a look at some Dow Jones facts. So what is the Dow Jones Index and why is it popular? The Dow Jones Industrial Average, to give it its full name, it's the second oldest US stock market index after the Dow Jones Transportation Average. So even people who maybe aren't that involved with markets are probably familiar with the Dow being used as a benchmark for US stock market performance. It tracks the value of the 30 largest US stocks. So at the moment, this includes companies such as Coca-Cola, Caterpillar, Apple, Microsoft, Nike, McDonald's. And these are updated regularly to reflect the changing nature of US business. So for example, after the dot-com boom in the late 90s, technology stocks clearly played a much bigger part in everyday life and business. So there was a shift that we've seen since then. And put simply, if you're buying or selling the Dow Jones Index, it's a way of gaining broad exposure to a group of large US listed shares. And from a trading point of view, it's clearly a market that even on a quiet day can swing around quite substantially. And this daily volatility is one of the main reasons that it appeals so much to traders. So how can you trade the Dow with Capital.com? Well, with us, you trade contracts for difference. That may be a term you're familiar with. CFDs on the Dow, which we refer to as the USA 30 Index. When you're trading using CFDs, you're trading using leverage. What this means in a nutshell, a small amount of money can control a much bigger financial position. There's more about CFDs and how they work on our website. So traders will use leverage to try and magnify the size of their profits. But it's important to understand, if you're magnifying your profits, then hand in hand with that goes the risk of magnifying your losses. So it's very important to use risk control such as stop losses. Another benefit of using CFDs, and it's a major benefit from a trading point of view, you can trade markets in both directions. So if you're a traditional investor, normally you have to buy and hope the market moves higher for you to make a profit. But when you're trading using CFDs, if you think a market is going to fall, for example, you can sell short. So you can position yourself to profit from falling markets if it turns out to be true. So you have this ability to trade markets in both directions. At the start of this, we looked at the bigger swings for the Dow. But what I've done here, I've just focused on the last couple of days at the time of recording. And you can see even over a 2-day period, the market, the Dow Jones Index has gone from about 25,900, traded as low as 25,550. So we've seen a 350 point move there, and then bounce back about 250 points as well. And it's this sort of short-term volatility that appeals to traders. Traders aren't necessarily looking at what's going to happen with the market over the next 6 months to a year. They're looking to try and profit from these price swings over a much shorter time period. And the Dow Jones historically has delivered plenty of volatility. So as with most of these stock market indices, the Nasdaq, the FTSE, the DAX, the popularity of the Dow is in the volatility. You know, we saw just over the last couple of days at the time of recording, the sort of swings we were getting through the day of a couple of hundred points. And it's this sort of volatility that appeals to traders. You can trade it using contracts for difference. So that way you can trade it in both directions. You can go long as well as short. Plus, of course, you have leverage. You can control a much bigger financial position. But as I said, you know, it's important that when you're magnifying your potential profits, you're also increasing your potential loss. So it's really important to use things such as stop losses to try and just limit the downside. You can find out more about CFDs and the Dow Jones by going to our website at Capital.com, but we'll wrap things up there. So from me, David Jones and Capital.com, good luck with your trading.